Hey everyone, welcome to another episode of the Backchannel. In the last episode, I started wading into the waters of valuation caps. My comment was that valuation cap is a term that many founders throw out there. They even negotiate around valuation caps. Many founders, especially first-time founders, don't have a really great understanding of what valuation caps are, how they work, how they convert. And that means that founders aren't really as sophisticated as they can be when they jump into the negotiating end of the table with investors, and they don't know how to control the situation. So after that episode, I thought we did a pretty good job of laying out how the math works, what the valuation caps are there for. And it brought up another thought that I had, which was the idea of uncapped safes or uncapped notes. Turns out that I had written an essay about uncapped safes a while back, and that continues to be the most popular essay that I've ever written on my blog. And so people are obviously very fascinated by this idea of an uncapped safe. I wanted to break down what an uncapped safe is, why founders are excited about it, why investors might not be excited about it. I'll talk a little bit about when I think uncapped safes are worth using and when they're not. And then you guys can react and let me know if there are other topics around the idea of uncapped safes that you would like me to discuss. So, what's an uncapped safe? I'll reference some of the stuff that I talked about last time around what a valuation cap is, but a valuation cap is essentially the valuation that an investor is expecting to convert their money at. Remember, when you're investing in a safe, you're not actually buying equity. You are getting a simple agreement for future equity. So when you put $1 million in at a $10 million valuation cap, this is not a conversion into a bit of equity immediately. In the future, when that company raises an equity round, your money will convert at those terms. And that's where the valuation cap comes in. Now, when there isn't a cap, when it's an uncapped safe, what's happening here? In an uncapped safe, there's usually a discount associated with the safe, a percentage discount as opposed to a valuation cap. So instead of saying, well, in the future, my $1 million will convert at a $10 million valuation for the company, instead, if you say, well, there's no cap, but to reward you for investing and taking on the risk, we will give you a 20% discount into the next round. What that means is, let's say today, I'm not sure what the valuation of the company should be, but we think it's somewhere around $10 million. We don't know what that's going to be, but if a founder convinces an investor to invest in an uncapped safe with a 20% discount, they could say, look, I'm about to raise money. We think it will be at a $20 million valuation. So in this case, with an uncapped safe and a 20% discount, if the company then went on to raise an equity round at a $20 million valuation, your $1 million would come in at 20% lower than that $20 million, meaning $16 million. So you were rewarded by investing a little bit early with that 20% discount. Now, it can seem like this is a very easy trade-off. Like, yes, look, I don't really know what the valuation is. I don't want to set the valuation right now. Let's instead just put a discount. That can seem like it makes sense. It's like, look, we're going to raise money. We don't know what it is. You might as well just take the discount. It'll be easier on everyone. Now, this can seem like it makes sense, but I can tell you based on my time at Greycroft, where we were burnt by uncapped notes and safes, that it's not great for investors in a lot of cases. So what are the situations that end up burning investors? Well, an uncapped safe with a discount will work if the company ends up raising capital fairly shortly after the investors come in on the uncapped safes. Because at that point, then, well, that discount will accurately reflect the amount of additional risk that they took on by coming in a little bit early. Like many of you, my last venture-backed startup was a SaaS business. In that company early on, we had the opportunity to sell into a large enterprise, but ran into some walls when they asked us if we were SOC 2 certified. Not only were we not certified, we also found out that it would take our small team a ton of time to get that done, and so we ended up abandoning the deal. If you haven't run into a situation like that where a potential customer or investor is asking if you're SOC 2, HIPAA, GDPR, or ISO 27001 certified, you probably will soon. But unlike me, you could use a company called Vanta to help. Vanta helps automate up to 90% of the compliance work, getting you audit ready in weeks rather than months, and eliminating up to 85% of the costs. Not only that, but Vanta can start small with you and scale up as you grow, helping you land bigger deals and earn customer trust. The best part is, Vanta is offering funded listeners $1,000 off for going to vanta.com/funded. That's VANTA.com/funded for $1,000 off your service. Check it out. But what I've seen happen is companies raise a large amount on an uncapped safe, or bring in multiple investors on multiple uncapped safes, continuing to add more and more dollars. So you thought as an investor, you were bridging them to a fundraise that would happen in a short period of time, $1 million, and that 20% discount would end up accurately reflecting how much you thought the company was worth. But what can happen is if you think you're investing in a company that, worth somewhere between $10 and $20 million, but you don't know exactly where that is, and you invest in this uncapped safe with a 20% discount, what can happen is that company might end up raising more capital, or that company might end up just being much more capital efficient. And what happens then if the company goes a year without raising, maybe 2 years without raising, and make a ton of progress on that money that you invested? And while you thought that the company was worth somewhere between $10 and $20 million, when they finally go out to raise capital with an equity round, they get priced at $100 million, which is incredible, except your money would then convert in at the 20% discount at an $80 million valuation. So you had invested 2 years prior to this $100 million round, but you were only being rewarded by having your money convert in at an $80 million valuation, when back in the day, a year or two prior, everyone thought that the company was worth something more like $10 to $20 million. So in my opinion, I don't think uncapped safes are a very good way to raise capital. I don't think it's good for investors, certainly. I don't think it's generally good for founders either. It's just an unclean, lazy way of taking in capital. I would much rather founders and investors go through the additional effort of negotiating a real valuation cap. Don't take the lazy route of just saying an uncapped safe, so that everyone has a clear understanding of where they stand. Now, look, there are certain situations where an uncapped safe may work. If you actually are raising a round that is a bridge to another raise that is definitely happening very soon, then if we all agree that that's what's going to happen, the uncapped safe can work well. I think those situations are few and far between. And even in those situations, you can go ahead and negotiate a specific valuation cap. But if you had to tell me, gun to my head, what's a situation that you would use an uncapped safe? It would be that. It would be a bridge to an equity round that we know is going to happen very shortly. Okay? Now that you know why I don't like uncapped safes, maybe you can go navigate the waters on your own and make your own decisions on whether or not that's something you'll want to bring up with an investor in the future. Okay, I hope you've enjoyed this episode of the Back Channel, and I'll see you next time.